Welcome back. This is another edition of Ask the Compound. Each week we get dozens of emails from our loyal Compound audience about taxes, markets, personal finance, portfolio management, Ben's latest fashion trends, Duncan's latest options trades. Email us a question here, askthecompoundshow@gmail.com. On today's show, we're going to answer questions regarding how much your savings should be used for a down payment on a new house, who's to blame for the broken housing market. We have a lot of suspects. Tax planning around an RSU went up 10x. I'm guessing that's NVIDIA.
Not bad.
We'll get to it in the question. How compatible you need to be with your financial advisor, and then optimizing your financial plan for life-altering medical issue. Today's Ask the Compound, sponsored by our friends at Rocket Money. I was on Rocket Money today, a handy little financial app on my phone. One of the cool things that you can do is kind of scroll through upcoming bills. And I have a lot of them, I guess, but it also kind of shows a little logo of what you're paying, and it's kind of like, oh, geez, I forgot I was paying that. What am I still paying that for? Once they start bundling all these subscriptions together, the streaming services, right, I'm going to use Rocket Money to negotiate better fees, or I'm going to bundle them all together and figure out which ones I can get rid of. Rocket Money is a personal finance app that finds and cancels unwanted subscriptions, monitors your spending, helps lower your bills so you can grow your savings. Rocket Money has over 5 million users and have saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Really fun little product.
I kind of like when it emails me and tells me that I spent less in that week than like the previous or monthly recap, whichever it is. I like that. Makes me feel
good. The
good.
Weekly bills, it gives you an arrow up or down. Cancel your unwanted subscriptions by going to rocketmoney.com/ATC. That's rocketmoney.com/ATC. All right, let's get to it. Good questions today.
All right, up first we got a question from Josh. Our family is planning to start a new build this summer. We live in mid-Michigan and are expecting the cost of our new build to be between $500,000 and $625,000. We'll have around $300,000 in a money market by the time we transition from the construction loan to a 30-year mortgage. We have $100,000 to $125,000 of equity in our current home and a 2.35% interest rate. I'm having a hard time figuring out the best route to take with the down payment percentage. I love the idea of having a low mortgage payment, putting down the $300,000 plus selling our current home and adding an additional $100,000 to $125,000 from the sale. On the other hand, I feel like putting down 20%, investing the rest, and renting our home out when the time comes, which could create $800 to $1,000 of cash flow per month, could be a better option. I'm 37 and I'm the single income provider for our family. I'm in sales, so my salary is hard to predict each year, but on the low end, I feel comfortable saying I make $200,000 a year. We have about $150,000 in retirement funds, $300,000 in a brokerage account, and our only debt is our home. I love the idea of having our mortgage payment in the 20% range of net income per month instead of 25% or higher.
All right,
is that like a general rule range that they're talking about there in the last sentence, 20%?
Remember my 50-30-20 rule?
Right, okay, yeah. Okay.
Usually the rule is actually closer to 30%, but so mid-Michigan, I'm guessing like Mount Pleasant area for all the Michigan fans here. Podcast bylines require me to say that there's a lot to unpack here, right? We got a lot going on, a lot of numbers. So here's what we're looking at. Josh and family take their current equity of around $100K and pair that up with $300,000 in cash savings when that new house is done. They'd be putting down something in the neighborhood of like 65 to 80% as a down payment, depending on that final purchase price, right? Sidebar here, I am glad that they're using a range for the final product of their new home because there's always upgrades and sticker shock and cost overages and such, as someone who's speaking from experience here. So the question is, does it make sense to put that much down just because you can, right? Obviously, just because you can do something doesn't mean you should. So here's some options for them. So big down payment, one, right? Lower that mortgage payment. Smaller down payment, but rent out the old house with a sub 3% mortgage. A lot of people have been doing that in recent years. Why would I give that up? So people become rental investors. You can do a smaller down payment and invest the cash, which makes sense if they want to up their retirement contributions and funds. Or you do a smaller down payment and invest some of the cash and then save some for, emergencies. So I think the spreadsheets matter, but the personal circumstances should be looked at through the lens. The spreadsheets should be looked at through the lens of personal circumstances. So here's what stands out to me from this question. Josh is the sole breadwinner of the family, and salary is hard to predict because he's in sales. I mean, it gives a floor for the salary, but you never know with these things. So for these reasons alone, I would be hesitant to put the huge down payment down. Also while keeping the old house, because that's just putting all your eggs in one basket of houses in an illiquid asset or liquid assets. So especially with a variable income and having no other sources of income, that would scare me. because so even if we did 20% down, which is kind of the old rule of thumb, if it's $500,000 house, that's $100,000. If it's $625K, it's $125K. So that still leaves you a lot of room. Even if you went 30% down, now we're talking like $150 to $190K, depending on the final price of the house. So even if you go at the high end of the estimate and put 30% down, you still have like $120,000 in cash left over from that $300K plus the old house. So, I think there's the rental piece is another one where do you really want to be a landlord? Duncan, you've dealt with rentals your whole life. Sometimes there's problems that happen, right? Your apartment can flood,
Right.
AC unit break, right? There's stuff that can go wrong. And so I'm not saying that being a rental investor is a bad thing, but if you're doing it, you're being pushed into it without knowing what you're getting yourself into, it can be eye-opening.
Yeah.
So,
I don't think I would want to be a landlord personally.
It's a lot. The toilet breaks in the middle of the night. It's not. I'm not saying that it can't be a good strategy. You're building equity. You're keeping that low fixed rate mortgage. I just think I don't like the idea of putting a big down payment down and keeping the rental property.
My idea is I want to have a parking lot. It's like the lowest maintenance thing ever. Just charge people to park their car on this land. There you go.
Yeah, but eventually the parking lot attendants are going to get sued because the parking lot spots are not big enough for the huge trucks and SUVs anymore.
See, mine would be special. It would have extra large parking spaces.
Okay, that's what I need. So here's where I land on this one. You have a job with variable income, so it'd be too risky to put all those eggs in one basket in terms of housing. I'd say keep some liquidity on hand for a rainy day. Yeah, obviously, the good news here is that they're very good at saving. They have $300K in a rainy day fund along with some retirement savings already in a brokerage account. I think at 37, you don't need to be in a hurry to pay off that mortgage right away. Maybe the new one, you're thinking higher rate. That's going to make more sense, but you have plenty of time to do that later. The good news is you're a good saver. I would spread things around here. Invest some of that cash, put some of it as a down payment, and then keep some for emergencies as well because you never know that variable income. That's kind of where I land here.
Makes sense.
Good luck with the new house, too.
Yeah.
Next question.
Yeah, congrats. That's cool.
Speaking of housing, here's another one.
You're always like a big build your own place, right, person, because you like that you can customize everything.
I just think right now building makes the most sense because a lot of the builders will give you some incentives. And I think people are more delusional in the existing housing market in terms of sellers than home builders are. I think home builders will work with you more in terms of negotiating than existing home sellers will.
And you don't have to worry about lead paint, I guess, right?
Lead paint, inspections, all that stuff. The beauty of a new home is that you get to pick the stuff out, but also there's less maintenance because you're dealing with all new products.
Yeah, that sounds nice. All right, up next we have another question from a Josh. 2 Joshes in a row. Do you guys really think foreign investments and private equity aren't driving up housing prices? I'm excited to hear you respond to this one because this is something I've personally in my life had people talk to me about that know that I work tangentially in finance. And they're like, these companies, are the reason that the housing market's so crazy.
I've seen the memes.
What's going on here? Yeah.
Everyone thinks BlackRock and Blackstone are the reason for low housing supply. They're buying up all the houses. I understand the sentiment here. The housing market is broken for a lot of people, but I think the blame is being misplaced here. John Burns consulting firm, their research consulting firm, has some good data on here. John, give me a chart on. Institutions own less than 1% of all single-family homes. There's like 105 million single-family homes. Blackstone owns 0.06% of them. Institutional families own 0.5% of them, so it's a very small number. Now, to be fair, those purchases have increased in recent years. John, give me the next chart on from John Burns. This shows the number of purchases by rental investors, and it breaks it down into 1 to 9 properties, 10 to 99, and then 100 and up. And 100 and up is considered institutional quality, right? Those are the bigger investors. And it's certainly been growing in recent years, and it got much higher during the pandemic when rates were low and cap rates were high for real estate investors. But all real estate investors were buying 12% of homes in 2002. That number is now more like 25%. So again, it's increased, but it's not these behemoth financial firms that you should be mad at. It's mom and pop people like the guy in our first question. It's people with less than 10 properties. So it's people who have 1 or 2 rental properties. It's just regular people who are buying and holding these things and renting them out. Big institutions, John, give me the next chart, make up less than 2% of purchases. At the height of the craziness for the real estate when rates were really low, it was still less than 5%. So there is more activity in certain areas. I don't know, Phoenix and Charlotte and some of these places. But if anything, it's shocking to me how little activity there is by big Wall Street firms in the housing market. It's really regular, normal people who are buying a handful of properties and renting them out that probably don't really know what they're doing. So
people who've had RSUs 10x, you know.
yeah, it's highly cyclical too. So here's some numbers from the Wall Street Journal. Investor purchases of single-family homes tumbled 29% last year. Businesses large and small acquired 570,000 homes in 2023, down from 802,000 in 2022. Why? Because interest rates rose. So that means cap rates go down. Now, how much you can make on those properties goes down. So if private equity firms aren't to blame for the unhealthy housing market, who is, Duncan? The Illuminati?
I don't know. I mean, I guess what people maybe get twisted here is you're not saying that there aren't people who have missed out on a house because a company came in and outbid them or bought it. You know, like obviously that's happening, but it's just not the reason that the entire housing market is crazy.
So here's why housing supply is so low right now. Okay, so we had the housing bubble in the early to mid 2000s, rising home prices, and then there was lax lending standards. So actually we overbuilt homes for a number of years in the mid 2000s. Housing bubble popped. We all know what happened there. Home prices crashed. Home builders, big and small, got annihilated. The team who built the home builder is a small West Michigan builder who built our first home that we built in 2017. We kind of talked to them about it and asked a little history about them as a home builder. And they said after the 2008 crash, business was so bad and they were left holding the bag that they left Michigan and went to Florida. They got demolished. And so coming out of that, lending standards got much stricter. And then after holding the bag, these home builders decided to pull back and get more conservative in the types of homes they've built. And they said, no, fool us twice, no way. We're going to build fewer homes, and we're going to try to increase our profit margins. And so the result coming out of the 2010s is that we severely built new homes coming for the millennial wave. So here's some of the numbers. Not only did we not build enough homes in the 2010s, but we had more people coming in. So this just shows the number of homes completed and the number of people in the U.S. added by decade for population. So in the 70s and 80s, we were building a lot of homes. 1990s, we did okay. 2000s, again, we built a lot of homes. But look at the 2010s. We've had more and more people come to the United States in population in terms of being birth and immigrants and all these things, but we built way fewer homes. We had a little bit of an uptick in the 2020s, but you can see we just haven't built enough homes over the years to compensate for the demographic wave of millennials. So it's not really anyone's fault. I mean, you could say, listen, there's rules and regulations in place that make it harder to build, and there are certain states and cities where this is certainly true. We need to make it easier to build homes. But a lot of this is just really bad luck. You had a housing bubble, the financial crisis, and all these home builders got whipped around and said, no way, we're not going to do this again. We're not going to get caught with our pants down again. And so now Zillow estimates there's 4.3 million houses that were short in this country. Like, that's how many we need to kind of even things out. And some people want to blame the Fed, but there's really nothing the Fed can do to fix supply. Right now, the mortgage rates are higher, and people say, oh, the Fed's keeping mortgage rates too high. That drives down housing supply because those 3% mortgage people just won't sell. But if the Fed lowers rates, then there's going to be more demand from people on the sidelines who didn't buy now want to buy. So it's not like Jerome Powell can snap his fingers and build more houses. So there's really no magic wand fix here. Luckily, it's possible it could just take some time and affordability will be fixed. JP Morgan, John, throw the next chart up, says based on current trends, housing affordability could be restored in 3.5 years. This is obviously baking in a lot of assumptions, and outcomes will be impacted by location and personal circumstances. But it's basically saying if incomes keep growing where they are now, housing prices keep growing where they are now, eventually we'll get, if housing prices kind of stagnate, it will become more affordable for people in a few years. Obviously, no one knows what the future holds, and it's possible we could have some exogenous event that just impacts housing prices or interest rates or whatever, kind of like the pandemic did in the opposite direction, right? No one predicted that, and it did. But I think short of an anti-pandemic response to housing prices, it's hard to envision a scenario where things improve meaningfully in a short period of time here.
Yeah, I think you've also talked about the size of places, how they seem to keep getting bigger and bigger. I think we probably will see smaller places getting built out of this, right? Because there have to be a lot of people like me. I lived in a 385 square foot apartment through the pandemic. Like, put me in a 1,200 square foot home, I'm probably going to feel like I'm in a mansion, So yeah, I don't think that we need so many massive, huge places, and then that'll help bring the price down a little bit, I guess.
385 square feet?
Yeah. it wasn't a lot of fun.
So that's like one of those things where you could reach out and touch both walls with both your hands.
In the bedroom, I mean, yeah, pretty much, yeah. But yeah, pocket door.
You're gonna be one of these.
Bedroom.
You can be a tiny home guy like on HGTV. But that is happening. A lot of builders are building smaller homes, and that demand it's coming. But yeah,
I wish I should have just bought like 5 properties in 2009 when I graduated college. But
yes,
live and learn.
But yes, I wish there was like some evil person or entity we could say like they're the cause of this housing problem. But it really was this confluence of events that caused this to happen, along with some stricter rules and regulations from government that is going to take a long time to unwind. Put away your pitchforks.
So to recap, if someone in Congress, made it to where these companies couldn't buy homes, it wouldn't meaningfully bring down housing prices, is what you're saying.
No, and again, they've already pulled back as it is.
Yeah.
All right. Let's do another one.
I mean, that's not as controversial as I was hoping it was, but yeah, good to know the facts.
I'm anti-controversial when it comes to financial advice.
That's probably good. All right, up next, we have a question from McMullen. I'm 47, and I've been managing my money without a financial planner. I've always been thrifty, but I also got some luck. My 401k is at $1.8 million, and brokerage is at $900,000. I don't have to worry so much about retirement. Kids are almost through college, and my mortgage is not a concern. I have RSUs that start vesting over the next 4 years. While I've been waiting for those to vest, the stock price has gone up almost 10x. I got a free forced 10-bagger. My default mindset is saving and limiting taxes, but if my RSUs don't go down as fast as they went up, I'll have a large windfall. I talked to a financial planner about reducing my impending taxes, but they didn't have any great ideas. How should I go about getting advice on taxes, and frankly, what to do with my windfall? I really don't need it for early retirement, and I just bought my midlife crisis car. They don't tell us what that is. I would like to know, but my hairline is thinning. Do I get hair implants next?
This is, other than the hairline thinning, this is like the biggest not to brag we've had in a while. Tons of money before they're 50. 10x. That's got to be NVIDIA. Maybe it could be a smaller company, I guess, but I don't know. It's got to be an NVIDIA or something. So let's bring on a financial planner who actually knows what they're talking about. Returning guest and Ritholtz Wealth Management, Nick Sapienza. First off, Nick, should our guy McMullen here invest in hair plugs or just shave it off?
I would say shave. But it wouldn't. Let's say that the midlife crisis car is a Corvette. I think that would be the trifecta. It would be a Corvette, hair plugs, and maybe a gold chain to top it off.
That's true. Pop the collar up.
Yeah.
Obviously, good problem to have here. RSU is up 10x before they even invested. The tax bill is going to be huge. Is there any way to prepare for? Because that's got to be such a big number. Is there even any way to prepare yourself for this, or not really?
To prepare yourself for a windfall or for the tax?
Yeah, for both, I guess. But it seems like it's funny that you'd worry about taxes in a situation like that where you hit the lottery.
Yeah,
that is one of those situations where
the more I've read this question, the more my mind's kind of changed a little bit about like what I was going to say initially. I was going to maybe like kind of attack the whole idea that he's worrying about taxes when he's won the game. And you've always said, you drilled into my head, you stop playing the game after you won. But there are a few things that he could do. I would probably be just as maybe emotional about this as he is if it really came down to it. So. In the back of my mind, I want to be, I think that's why it works. It helps to work with someone that's going to be less emotional, more objective about this. But when it comes to what can he do, like just to get to the specific question is, I would say first and foremost, it's 50% of a watermelon or 100% of a grape, right? It's like, if you lost money, you paid less in taxes, but who cares? Like you still went down in value. So
that had to be a Louisiana line of speech.
That came from Paul Zotner.
Okay,
so that from Paul.
There's
still most one-liners from Paul. Yeah, but a few different options for him is of course he could gift it. Maybe he could do some accelerated gifting there with his kids or other family members. He could use a donor advised fund. This is a big one, right? So using a donor advised fund, gifting a good chunk of the stock. Gifting it to into the donor advised fund, and then doing some more tax planning around that. Depending on the size, I don't know if it's $100,000, $1 million, or $10 million worth of stock here. He could, direct indexing is a strong case for this to wrap the portfolio around the position and kind of coalesce it into a more diversified portfolio over time while racking up tax loss harvesting. So.
That's, you slowly leg out of the position.
Slowly leg out of it.
Tax loss harvest along the way.
At the same time, though, you have to maybe have a disciplined sell plan in place where you say, you know what, we're going to sell a quarter and hope it grows back. and we're just going to continue to sell a quarter and continue to sell a quarter and just stick to that plan no matter what. Maybe accelerate it at certain times if the stock, like if it is NVIDIA and the stock is soaring above $1,000 a share right now, maybe you do a little bit more than say, that 25% portion. Then lastly, very probably rare use cases from what I understand. I think Josh has often referred to these as murder holes, but exchange funds. And you could probably talk about the exchange fund piece, but there are some, the benefits would be that he transfers his stock to the exchange fund. He gets a more diversified portfolio. He defers some taxes. Some of the downsides would be something like a 7-year lockup, so no liquidity on that. Performance, who knows what that looks like. It could be severely underperforming the overall market, depending on the stock. Some other opportunity costs from doing that and just not paying the taxes and moving on. And the fees, right? So upfront fees in some cases, or 2 and 20 in other cases. So pretty costly. So really weighing the pros and cons there. I know there's option straddles and whatnot, but not to get too much further down that rabbit hole.
Yeah, you can do an options type of strategy. I also wonder what the emotional cost of just ripping the Band-Aid off, selling them all right away and just taking the tax hit, being like, I already am up 10x, I won, let's just do it and move on. Yeah,
there's no world in which you were going to not pay taxes on this. So it's like that should be baked into the equation. If you have $1 million, that 30% or so is for taxes, the rest you keep, right? So just it might take a while for your mind to catch up to your financial situation, but those are a few things that you could do right away.
Speaking of grapes, are we talking cotton candy grapes here? Because I swear those did not exist when I was a kid.
I don't know if that's a genetically modified grape or not, but I will take down an entire case of those. Yeah, and they're $10 at Costco, which kind of blew my mind, but
Yes, my wife is constantly loading up for our kids. All right, next question.
Can we talk about how much better grapes are than raisins?
You know how much better wine is than raisins and grapes?
Tomato, Duncan.
There you go. Okay, up next we have a question from Larry. I'm thinking of turning most of our 2-comma portfolio over to an asset manager. One fellow I'm considering recently revealed his personal spending habits to be woefully inept and driven by ego as much as any rational objective. Am I silly to think that if he is just plain stupid with his own buying decisions, he might not be so smart with my money? And
I'd love to know.
I have another question to add on to this after you guys discuss.
I would love to know what Larry's talking about. Was it a midlife crisis car? What are the spending habits?
Well, it's like we talked about before the show. Is it a money dial sort of situation where it's like I just really like to spend. I don't have a huge house, but I've got the nice car and a watch, right? That's what I'm
my
into.
Mind,
maybe.
I'm thinking here about compatibility because obviously you want to have the same principles and values as a financial planner. But so when we were in college, I was in college in the early 2000s. When my friends and I would get done with classes for the day, we'd all congregate in someone's dorm room, sit on the futon, and watch 6 dating reality shows in a row, right? Remember the Fifth Wheel, Eliminate, Blind Date, Next, all these, right? And I'm picturing this for financial advisors, right? For how a dating style show for choosing your financial advisor. But how important do you think it is to be on that same wavelength as your financial advisor? Even if some people might assume that money dial thing is rational for this financial advisor to be spending on, how important is it do you think to be on that same wavelength?
I think that's everything. Is how much confidence and trust you have in an advisor. That's the only thing that matters at the end of the day. So
the trust is a huge piece of it, right?
Yeah, you have to trust. You have to be able to take them seriously, especially because it's going to be everything's fine right now. But so the way I think about it is, if I'm hiring a personal trainer, he or she doesn't need to be 7% body fat, walking around at stage weight at all times, but maybe not morbidly obese either. Or if I'm going into a doctor's office and he's telling me to quit smoking, but he was just outside ripping heaters, I'm probably going to take his advice a little bit differently than if he were the beacon of health, the Peter Attia, right? So I think that we've got to be at least close to being on the same page. Again, it could be a money dials thing where that's just what he spends money on. But ultimately, if the other side of that is, does he or she lack the discipline to go through the process themselves? I think you have to help yourself first before you can help anyone else. And more importantly, so much of the value that you can add to someone's life is going through the experience of going through a process over and over again, and the intricacies of that process and all the nuance and all that. That's where the real value comes in, is at the margins. And so if they don't have experience in doing that themselves, how can they really be the best guide for you? If they do lack discipline, think about the most extreme times, like when you need an advisor most, either personally or in the markets, when markets are at all-time highs or all-time lows. Are they going to stand by their rules and be disciplined in their process and keep you in the game, or keep you from chasing performance, or are they going to be an enabler?
Yeah, so that's true. Yeah,
this guy should trust his gut when picking
I think if you don't trust their personal judgment, there's no way you're ever going to take their advice,
Yeah.
good, bad, or otherwise.
Yep.
So a little different than the question, but do you think it's important that someone likes their advisor, like as a person?
Well,
Because
Josh
I
always
ask
talks about
because
this.
there are people who have doctors that they don't really like, but they're the best at what they do, or a dentist that's really good and really thorough, but they don't love them.
Yeah,
as a
but I think
person.
the
good
bedside
point.
table is the bedside table manner is really important. I think for an advisor. Josh always says that, like, right or wrong, especially in financial services, people work with those that they like and respect. And you have to have that level of expertise. But I think if you're just a robot who can spout out, different insurance and taxable and financial planning stuff, the empathy and the trust and working with people, I think that's a big part of it.
Yeah, I guess they don't have to love you, but they have to like you. Hopefully, my clients love
I guess
me.
I'm now picturing Michael.
I love
I'm
them.
picturing Michael Burry in The Big Short. How
Yeah.
his investors hated
Yeah.
him.
Yeah, I don't think you can be a robotic as a person in a trust-based, service-based industry like this. There has to be some personality or something there.
And people wanted to fire Michael Burry. They were capitulating, right? According to the movie, at least in the book.
Yeah.
Like, they wanted out. So
Fair question. All right, we got one more.
Okay, last but not least, we have a question, a very long question, but good question from BC. Married, both 47, no kids. We both got our lives upended by two major long-term life-altering health diagnoses in the last 2 years. Unless science really pulls a rabbit out of a hat, it's a matter of when, not if, we'll both be forced to stop working. I really like my freelance career and want to keep doing it until I'm no longer physically able, maybe 3 years if I'm lucky. Spouse does not love her high-stress job and would like to exit the workforce now to deal with her health issues. She has a much better long-term prognosis than my condition if she takes care of herself. Together, we make about $400,000 a year before taxes, split evenly. Our cost of living is about $100,000 annually in a ridiculously high cost of living city. We have $59,000 left on a $300,000 mortgage at 3.75%. We have $1.7 million in our 401k accounts, $600,000 in brokerage, and $500,000 in a high-yield savings account emergency fund. We've poured money into this fund for the last few years because we may need that cash to live on soon, especially if we go down to one income. I do have a $2,000 a month pension that will kick in at age 52. Healthcare not included, sadly. We tried but can't get long-term care insurance. Candidly, I'm not sure I'll make it to 59 and a half or what shape I'll be in if I do. Should one of us or both stop contributing to our 401ks now and coast FI? Can we coast FI? If my spouse exits the workforce now and I'm forced out by age 50 due to illness, can we make things work financially until age 59 and a half with what we currently have saved and invested?
All right.
And so
Obviously,
coast FI, obviously I had to ask you guys before, so you might want to define what that means.
coast fixed income. Like, do we have enough money where we can stop saving? We'll still work for a little bit and bring income in, but we can just let the earnings
It's
compound.
like financial independence without the retire early.
Yeah. Obviously, this is a tough break, and I don't know if it's better or worse that you're going through a similar major illness with your spouse. But I guess the thing to notice here is that sometimes these decisions are like the hard decisions are made for you, right? Some people say, I'm going to work till 70, and maybe you can't work till 70 because of an employer who won't let you or health illness that won't let you. It's interesting. So many of the questions that we receive in this show are life-based events, graduating from college, marriage, buying a house, divorce, retirement, and sometimes mortality, right? And this is one of the weird things in that one of the hardest things to plan for in financial planning is longevity. And we all know that someday we're going to kick the bucket, but some people might have a better sense of it than others. So, Nick, how do you handle this piece of it when maybe you have more parameters around this in terms of maybe the money's not going to have to work as long, or I'm not going to be able to work as long? How do you think about this?
Yeah, first, very sorry that this is the case for these people. I wanted to see if we could take it a step further and do more to help here. So created a financial plan for them just using the information they've given us. But yeah, the runway is kind of shorter, right? So the question was, we're spending ultimately they'll be spending $85,000 a month plus healthcare costs. I don't know, it sounds like maybe one of them has a terminal illness, maybe the other not so much. He's asking about stretching it to 59 and a half, when in reality it's really 55 is kind of the bogey. But with the Secure Act 2.0, it might actually be sooner. So you can tap into, you can take a distribution from a qualified plan, an IRA or 401k, without the 10% penalty if you have a terminal illness.
I was going to ask if there's any
So
financial
to
planning
cover those
issues to consider for terminal illnesses.
That
So
would
there's something
that
you
would
can
be
do.
the big one. Yeah, not that they need to though, because they're so well set up for this for retirement. They have so much in not only in their 401ks but also in cash.
So they're in a pretty
and
good
brokerage
position
account.
based on their spending needs, right?
They're in a great position. Yeah, they have a low withdrawal rate and they have a ton of assets. So they'll be able to cover this in the financial planning. Some of the charts that we have. So we can pull up maybe the first one. Don't really know what to put here for life expectancy. Hate to be too morbid about this, but Joe, and I put Joe and Jane. So let's just say that he said he wants to retire, or maybe retire at 50. She wants to retire now, and I don't know what to expect for life expectancy. So we can kind of toggle back and forth between this. But maybe the money might need to last for 36 years. If we move on to the next one, we can see a better breakdown of what that spending might look like going forward. So we have a baseline level of expenses, which is $85,000, and then we have the healthcare expenses, which we have pretty good estimates, not only for what it might cost, but what inflation has been historically. So the inflation number is going to be about 6% versus their ordinary living expenses, maybe about 3%. So you can see the green is their living expenses, the blue is their healthcare, and blue is going to rise pretty rapidly. And we've given them sort of like this below average rating for healthcare, so it's $12,000 a year instead of $9,000 a year, and how that increases over time just very linearly. I think, of course, they're probably thinking about different things now. Values have changed, right? They had a completely different plan and set of values before and after they walked out of that doctor's office, I would imagine. So maybe they're looking at spending more, gifting more to people, to family members now, taking more trips, and so on and so forth within what they can do. Going on to the next chart, we've got a breakdown of just what this cash flow looks like for them. So the pension starts at 52. Social Security, I would guess, is going to start at 62. I don't know exactly. He was a freelancer, so maybe I don't know exactly the Social Security situation there, but we have some estimates for them. And basic living expenses at that time would be a little over 100,000. Healthcare would be 36 to 40 grand. And so they're still able to cover that bogey quite a bit. And the reason why they can do so is next chart. Their assets should be roughly at about $3.4 million. So they've got things bucketed the way that we would pretty much recommend them anyway. Maybe a little heavier on the cash side. $500,000 in cash is probably.
So you're on the estimates here, and you pick some sort of withdrawal rate for them to start with, right?
Right. Well, this is just based on their current level of expenses, which is $85,000, and they're still at less than 5% on their withdrawal rate. So it's a perfectly healthy, totally healthy withdrawal rate. And I would also maybe even take the withdrawal rate with a grain of salt because of the fact that they have the cash, they have the taxable assets, and not only can they tap in due to maybe terminal illness, if that's truly the case, through Secure 2.0, but they also have the age of 55 rule, which is at 55 they can start withdrawing from their 401ks without penalty. And right. I don't know.
And you could probably even say, listen, if you're going to want to enjoy the next 5 to 7 years when your health is going to be better, and you want to crank that dial up now and spend more now, and then your spending is probably going to go down in the future, like that's the kind of thing you probably look at too. But it's good to know that you've kind of ran the financial plan for them and say, like, you're in pretty good shape, actually.
Yeah, exactly. Yeah, just rather than just telling them, okay, you're fine, yeah, go move forward, let's run through the numbers, let's actually look at the cash flow and show you that, yeah, even with all things considered, that withdrawal rate is still very healthy.
And especially something, it sounds like this is a physical ailment that they know they're going to be getting worse and worse.
Yeah.
Yeah, I'd be comfortable saying, like, spend more now. Enjoy it now while you still can, and you know that this is coming down the pipeline.
Yeah. Like I could tell you what I think I would do, which would be traveling more if I could, gifting, doing whatever I can, just making the best use of it.
Yeah, for a lot of people, I know a lot of financial advisors use these kind of things as like hypotheticals, right? If you knew you're going to die tomorrow or next year or 5 years, what would you do? This person and his wife can kind of think about that now, and it forces it to the forefront of their thinking. Not only their financial plan, but like, what do you want to do personally?
Yeah, exactly.
Also, not really from a financial standpoint, but just from a health standpoint, the part where they say that their spouse doesn't like their high-stress job, but then also says that their prognosis is better if they take care of themselves. That seems kind of self-explanatory then, right? Like,
right.
I mean, I would leave the job then. I mean, stress is one of the biggest
Nick,
killers.
if your financial plan says you're fine right now based on the assets you have, your wife can quit the job, then if she can, and it's going to improve her quality of life, do it.
Yeah, so first of all, they can stop saving, whether or not they quit. They can certainly stop saving.
So that co-FI, they're certainly
they can co-FI
for
sure. Yeah, but I would definitely be leaving that job. And in her case, maybe even if it's a sabbatical, it doesn't matter if it's a sabbatical or not. Yeah, I would be out.
Yeah,
same.
Right. And listen, BC, if you want to actually talk to a financial advisor, Nick is your guy.
I'm here.
Right?
Give me a shout. Yep.
All right. Nick, thanks for helping us out today. As always, I liked all the
Yep.
charts there.
It's fun.
Check out tomorrow, all new episode of The Compound and Friends. Duncan is going to be very well behaved. What was the problem, Duncan? Bad mic earlier this week?
Oh, on what are your thoughts? Yeah, input issues. Yeah.
Okay.
Jeez. It's all good.
Rookie mistake. Email us, askthecompoundshow@gmail.com with your questions. Leave us a comment, a question, a review on YouTube. We'll be back next week with a very special guest, and we'll see you then.
See you, everyone.